Good afternoon and welcome to the Fess Parker Double Tree. Hey, wait a minute. Where is everybody? What? We did it again? Okay. We're going to do this virtually again. Good afternoon. I'm Paul Hurst with Berkshire Hathaway. Glad to have you with us. We are going to have this online again, like we did last year, so bear with us. The seminar will be recorded and available tomorrow through the SBAOR newsletter and SBAOR website. This is an audio-visual event only. Q&A will not be available, and we will be raffling off items throughout the event, so please pay attention. Raffle items can be picked up or dropped off to you. Please contact Casey Gillis if you are a winner. And I'd like to thank and welcome our featured sponsor, Judy Eganoff and Samantha Moon of Amherst 1031 Exchange. That's the sign back there.
Thank you, Paul. Amherst is proud to be the featured sponsor for this year's real estate market update. I'm Samantha Moon.
And I'm Judy Eganoff. And Samantha and I have a favorite subject. It's tax-deferred exchanges, surprise, surprise.
And at Amherst, we handle forward exchanges, reverse exchanges, improvement exchanges, and love discussing all aspects of exchanges. We also pride ourselves on our expertise, level of service, and protection of funds.
We've been your local resource for tax-deferred exchanges since 1988. That's a long time. So please give us a call anytime an exchange question arises. It's 962-6262.
Or visit us online at amherst1031.com. That's AMHERST 1031.com.
Have a great market update, everyone.
We'd like to give a special thank you to the 2021-2022 Statistical Review Committee. We've got Chris Agnoli, the committee chair, Diane Johnson, Jackie Walters, Jim Whitmer, Kalia Rourke, Karen Shackle, Liz Heitman, Matt Genovese, Patrice Serrani, Samantha Ireland, Sue Irwin, Terry Gauthier, Devin Wong, and Marcella Simmons. Thank you to our grand prize raffle sponsor, the Santa Barbara Independent, and in particular, Sarah Sinclair. The Statistical Review Committee appreciates your continued support with advertising and all your involvement with SBAOR. This year, the grand prize is 4 $100 gift cards to local restaurants. That should be pretty good, so listen up when we call for those. Thank you to our supporting sponsors, Styled and Staged SB, Fidelity National Home Warranty, Finance of America, Delicious Decors, First American Title, Prosperity Home Mortgage, First American Home Warranty, Guaranteed Rate, Homebridge Financial Services, Fidelity National Title Company, and Chicago Title. And thank you to our broker sponsors, Suncoast Real Estate, Coastal Properties, Village Properties, Keller Williams, Berkshire Hathaway Home Services, Sotheby's International Realty. Okay, before our program begins, let's get the excitement started with a raffle drawing. We would like to thank our raffle donor, Terry Gauthier with Union Bank. Okay, sorry, I just had to take care of something. Interestingly, I put a doghouse up for sale on Craigslist, and I already have 4 offers over asking with a 1-year rent back. Pretty wild. So I'd like to welcome and thank our first presenter, CAR economist Jordan Levine. Jordan Levine is the Vice President and Chief Economist of the California Association of Realtors, a statewide trade organization of real estate professionals with more than 200,000 members, most of them locally. Jordan is responsible for CAR's housing market and economic research, as well as the policy analysis for CAR's legislative and government affairs efforts. He has a passion for home ownership, is actively involved in the company's diversity, equity, and inclusion initiatives, and regularly represents CAR to its members, the real estate industry, policymakers, and in the local and national media. Jordan has a bachelor's degree in economics from the University of California, Santa Barbara, and a master's degree with merit in international economics from the University of Sussex. Prior to joining CAR, Jordan worked in consulting as an economist and director of economic research, where he oversaw all research and economic analysis on California's economy and housing market and regularly spoke to trade groups, public officials, businesses, and the media. Would you please welcome Jordan Levine?
Hello to all of my friends at the Santa Barbara Association of Realtors. In some ways, this is my kind of home AOR from back at my Gaucho days. But my name is Jordan Levine, and I'm very excited to have the opportunity to address you today, albeit virtually, to present our 2022 economic and housing market forecast, both for the state, and we'll talk about some local data as well. I do certainly look forward to the opportunity to get back together with you all in person. Definitely thankful to the staff to at least be able to bring you our update here for your annual event. So let me go ahead, share my slides. We'll look at some pictures. We've all suffered enough. And, for me, I think the bottom line is that we're still pretty optimistic, but it's a cautious optimism because we do see several sources of potential headwinds. Not that we think that's going to disrupt the overall trajectory, but I think it's going to be more of a situation where we're not able to hang on to those 15-year highs for transactions that we've seen over the course of the last couple of years. In some ways, it's kind of a tale of contradictory forces out there. On the one hand, we very much see a lot of signs that the market is starting to normalize. A lot of that kind of homegrown demand is starting to come back after we saw folks really moving around, and out migration play a big role, certainly at the start of the pandemic. And yet, even as that kind of migratory pattern is starting to fade from the forefront, what we do see is that a lot of those kind of pre-existing conditions, those long-standing structural changes that we'd been dealing with before the crisis, are now even more acute in some ways as a result of that crisis. So we have more folks with flexibility to work remote. And I think that's good for markets like Santa Barbara, where folks will increasingly look to get away from, those kind of dense urban employment centers. But at the same time, I think it means, supply, housing affordability, those challenges for home ownership are still very much alive and well as well. What about the broader economy? When you look at the kind of 30,000 foot perspective, I think there is certainly a lot to be optimistic about, even as we kind of rode out this most recent flare in the COVID numbers, which saw new cases rise to unprecedented levels thus far. The kind of macro economy has continued to move forward despite all those challenges, right? We've had a fairly consistent uptrend in things like employment, GDP, improving unemployment numbers, even rising incomes. And so I think from that standpoint, we can expect that broader economic environment to continue to improve. And I think with housing specifically, we can be even more optimistic because up to this point, we've been on the leading edge of that broader economic recovery. And I think that will remain true for many reasons as we move forward. Of course, I'd be doing you a disservice if I didn't alert you to some of the headwinds that are brewing out there. Of course, we heard about inflation. We've heard about the rise in interest rates, which is certainly something that's going to be very relevant this year. But I think, again, the long-standing challenge is the one that's still at the forefront, and that remains housing supply, both in terms of existing housing turnover, right? We need more of our homes that we already have built showing up on the MLS, but we also need to continue to fill that pipeline with new development. So what it all kind of means when you break it down to the individual practitioner level, I think, is that, again, we can be optimistic. On the one hand, we have consumers that I think need us more than ever, even on the buy side, right? You have folks that are moving to markets they don't have a lot of experience in. They're buying product types that they weren't in the market for before. And so our expertise is I think, even more necessary and in demand than ever. On the flip side, I think we have to work harder than ever because, on the buy side, again, we've got our work cut out for us in this inventory constrained market. And of course, when it comes to listings themselves, there simply aren't enough listings to go around relative to a population of realtors that also continues to grow. And so even though we're optimistic about the economy, about the housing market in particular, still very much a foot on the accelerator type of an environment when it comes to the individual real estate practitioner. And I think that, the conditions are there, supportive for you to grow your business this year. You just want to make sure that you take that kind of elbow grease approach to it. Let's talk about the economy real quick, because there is a lot to be optimistic about. And we just got national numbers for January, and those numbers were actually exceeding expectations. We don't have California yet, but you can see even through the end of 2021, we had already added back almost 2 million, a little more than 2 million of the jobs that we lost during the downturn at the onset, right? We lost about 2.7 million jobs. We've added back about 1.9 million of those up to this point. And even with all these spikes, and perhaps even more importantly than the magnitude of the improvement, is how consistent it's been, right? Even with the kind of ups and downs and the start-stop nature of our economy over the course of the last couple of years, the macroeconomic trends have been almost consistent and have been consecutive pretty much for the last couple of years in terms of adding more jobs to non-farm payrolls. In fact, we're about 70% of the way towards full economic recovery. What's also really important to note, especially in the context of some of these newspaper articles that I've been reading lately talking about why California can't get its economic act together, I think this chart is critical, because you can see that we went harder, faster, for longer when it comes to the COVID stuff. Our employment contraction in 2020 was deeper, and it stayed low and was more sustained negative for a longer period of time. But if you look at what's happened through the last 6 months of 2021, California, not only resumed its kind of upward trend in terms of year-to-year growth and employment, but actually for the last 6 months of the year was outperforming the U.S. once again, which is something that had been the case for many years leading up to the pandemic, right? Is that California's been in the top 10 states in terms of overall economic performance. And even though we have a bigger hole to climb out of, we're starting to resume that kind of place at the forefront of broader economic growth nationwide. So that's a good thing, right? When you look at the distribution of those almost 3 million jobs that we lost in 2020, you can see, despite being a relatively resort heavy, quote unquote, market, and what I mean by that is that a bigger chunk of our local economy is concentrated in things like bars, restaurants, hotels, retail trade, etc. We were pretty much middle of the pack when it comes to those pandemic job losses. We cast off about 16% of our non-farm payroll, certainly not as bad as San Luis Obispo, Monterey, Santa Cruz, other parts of the Central Coast. And I think that's largely due to the luxury market and a lot of that in-migration of high-income earners, particularly at the onset of the crisis. And yet, when you look at the kind of recovery numbers, even though we weren't hit as bad as some other parts of the state, we're actually recovering even faster. The state as a whole's about 71.5% at the end of December to full economic recovery. You can see Santa Barbara's punching above its weight a little bit. We're about 75% of the way there. So we've added 3 out of the 4 jobs lost during the downturn back. We've still got a little bit of that ways to go. But again, making consistent progress towards that full recovery number. And that is important from the standpoint of housing, because, a better economy typically is better for housing as well. And that's something I think we can look forward to. But it's not just the improving economy. One of the lasting changes, I think, that we'll be able to see coming on the back end of this crisis is this kind of renewed passion for home ownership. Our former CEO, Joel Singer, called it the value of home. And we saw that value increase, counter-cyclically this time. Usually when the economy is bad, the housing market does bad as well. But due to the nature of this crisis, where we live, work, and play there, where we're stuck there for months on end, we really saw the kind of value of home ownership, which has been fairly evergreen throughout California history, got renewed once more. And actually, you can see for the last 2 years, And this is data from our 2021 housing market survey, annual housing market survey. Here you can see that we had a second year in a row with elevated levels of first-time buyers actually getting into the market, right? That folks that were in many cases long-term high-income renters finally taking that plunge and getting their foot on the property ladder for the very first time. And actually newly released data from the census for 2020 shows us a lot of the same things that we saw reported by our members in the annual housing market survey, namely that home ownership actually went up. We didn't just get realtors reporting that they were working with a lot of first-time buyers. The Census Bureau backed that up by showing us an increase to about 56% in terms of that statewide home ownership rate. So again, that renewed passion for home ownership was alive and well, but we also saw folks who already own property have an even bigger appetite for property, right? We saw a lot of folks going out and scooping up even more vacation homes, second homes, and so you have this kind of two-pronged source of really robust housing demand over the course of the last 2 years in 20 and 21, despite the turbulence in the broader economy. So now we have this, kind of economic tailwind that's happening, and it's butting up or kind of conflating together with this structural shift in the importance of housing. And indeed, when you look at the actual market data, right, now that we've closed out 2021, I can tell you that we had the best year for home sales in over a decade. This data goes back to 2010, but I think it's actually better than all the data going all the way back to 2009. So about a 12-year high for transactions. If you look at the monthly numbers, at one point, we got up to a 15-year high. So again, we saw the improving economy, the renewed passion for home ownership, the increase in flexibility, and these historically low interest rates really show up for us in terms of the amount of closed transactions that we were able to sustain. When we look at how the local market performed relative to the state as a whole, you can see both the Central Coast and Santa Barbara County specifically had a better year in terms of increases in closed transactions than we saw even in the rest of the state. Of course, you can see how that's subdivided out sub-regionally. And here I have the sales growth broken down or sorted from highest price in Los Olivos all the way down to lowest price in Lompoc. You don't really see much of a pattern jump out when it comes to high versus low price markets. But if you sort it from north to south, you can really see that the South County in particular, I think, continues to outperform. And I think in many ways that kind of overperformance that we see with Goleta, Santa Barbara, Carpinteria in particular, really punching above that statewide average is a function of the broader economic trends, right? If you think about South County, again, with the exception of Los Olivos, that's where most of the higher cost housing is located. And given the fact that high income earners continue to do better than the economy as a whole, stock market has continued to outperform. Property values obviously have risen much faster than wages and incomes. I think it makes sense that you see this kind of geographic skew with South County doing particularly well, although we saw, again, decent growth across the board in Santa Barbara County as a whole. One of the reasons why the median price statewide is up still at almost an all-time high of around 800,000, growing at an 11% clip on a year-to-year basis, is because those high-cost markets continue to outperform the broader economy. And when we sell a lot of homes in the $2, $3, $5, $7 million range, it tends to drag up these statewide median prices. But it's also a function of just how competitive the market is, right? That we didn't just see prices getting bid up by double-digit pace in terms of overall median price growth. We saw a lot of folks paying cash out there. Those numbers were actually up to almost 19% of buyers last year, but it wasn't just competing on the basis of price or on the basis of cash. we also saw some really eye-popping numbers in terms of folks actually waiving contingencies, whether that was contingency on selling your previous home, on whatever happens with the appraisal. We don't care what the inspection turns up, et cetera, et cetera. And so it just led to this, this kind of renewed passion for home ownership, the improving economy, the low rates, et cetera, really butted right up against our lack of inventory to create this kind of hyper competitive market for buyers out there. And of course, we saw that in the local market as well. That the exception, I guess, to the rule there is these hyper expensive markets of Los Olivos, Montecito, to a lesser extent, Santa Ynez, although I think they're still up in the $1.2 million median price range, where we didn't see as many of the homes selling above asking price, but pretty much across the board, especially as you get into some of the cheaper markets across the county, or relatively cheap, I guess, by the standards of people outside of Santa Barbara County. These still aren't very affordable, but you can see how a tight market really drives these incredible numbers, not just in terms of sales growing, prices growing, but the number of homes that are actually selling well above asking price. And that was true for us in the local market as well. We do see signs that the market is starting to normalize. Investors came back to the market in bigger numbers for the first time since the beginning of the pandemic, still less than 10% of overall transactions. And most of that growth actually came from flippers. We still didn't see a big increase in people buying, holding, and renting, but we did see more investor activity in the marketplace last year. We also saw investors from across the globe come back a little bit as well. Again, a relatively small number at less than 5% of the overall market, but the first time we've seen those numbers increase since the onset of the pandemic as well. Biggest place we see it is in the market data, right? The distribution of transactions. Here you can see that homes priced at 2 million and above have been growing much faster than the rest of the housing market throughout the duration of this recovery period. But what you can see is that even though the top end of the market continues to outperform relative to all other segments, it's growing by 20, 30, 40%, not the 300% and 400% increases that we had been seeing back during the summer of 2021. We still think the top end of the market will continue to do well. High income earners are going to continue to do better. We think home prices will continue to outperform broader economic growth. But again, we're seeing that normalize down from triple digit down to double digit growth, right? So again, nothing to be too concerned about, but it's definitely something that kind of suggests against going into a cruise control type of approach to transactions this year. You also see what people are buying starting to normalize. We saw the size of home purchase jump up by about 120 or so square feet pretty much instantaneously at the onset of the crisis. Those numbers have started to cruise back down into the kind of 1,740 square foot range, where they were fairly constant leading up to this crisis. You see it geographically, and I mentioned how the Central Coast, continues to outperform the state as a whole. You can see that was true in Southern California and the San Francisco Bay Area too. It's not all driven by growth in the Central Valley in the far north, and I know it's painful to admit it to ourselves, but we're not, unfortunately, all going to be working from houseboats in the middle of Lake Shasta. For me, when you look at the kind of biggest headwinds for me, the challenge that we have is figuring out how to find the housing supply to put these buyers into. The economy is coming back. There is that renewed passion for home ownership. People do have more flexibility about where they work and live, and yet the number of active listings is depressed, even by the kind of depressed standards of 2018 and 19, which were terrible years for active listings. We're still running about half the pace that we had back then. And you can see that those declines started to accelerate in December, right? That the decline in listings, which has been long standing going back to the kind of halfway point of 2019, was looking like we had something to look forward to during the second half of 2021. That last quarter really showed us that we burned through a lot of that existing supply once more. And unfortunately, we're not replenishing at a fast enough rate. Here you can see not total active listings, but new listings that are being added to the MLS each month across the state. And for the first time in many years, we had a month where we added less than 11,000 housing units to the MLS throughout the course of a 31-day period there. And that puts us even further behind the 8 ball from an inventory standpoint. And that's why I think we're starting to see signs that the supply problems will bleed over to the demand side at least a little bit, not to the point where we're going to lose housing demand and we have a threat to home prices or anything like that, but to the point where we're not going to be able to hang on to those 15-year highs for transactions. You can see that new purchase applications for mortgages has been falling now for the better part of about 7 months in a row. Our pending sales index here in California has also been in decline since June. And so again, we're not seeing the market fall off a cliff, but we're definitely seeing this normalization, not just in the kind of what and where consumers are buying, but also in the number of home sales that are actually transacting out there. And this is due to all kinds of reasons in addition to the supply. And again, I think that there is at least some demand component. You still see the percentage of consumers that we ask in our monthly survey if it's a good time to buy are still pretty depressed, even by the standards of kind of where they were before the crisis. And that's why you see, even with listings being a huge problem, that the competitiveness numbers are declining a little bit. We've gone from about 75% statewide of homes selling above asking price down to less than 60%. It's still a hyper competitive market, but it's kind of that plain old boring red hot, not the sizzling, crackling white hot that we had during the summer of 2021. So again, I'm not trying to scare you off the housing market. I'm just trying to warn you against the cruise control type of mentality that you might interpret by looking at this renewed passion for home ownership, the constantly growing home prices, the big numbers of home sales, and the fact that we're still optimistic looking forward and thinking that it means that we're going to be able to get all of these buyers into homes. And that's before we even talk about the kind of compound effect of, rising inflation, which is going to cause the Fed to be much more aggressive. In fact, we're expecting a rate hike here in the next month or so when they do their first open market committee meeting of the year, and probably do at least 3 or 4 through the balance of the year. We've already seen rates rise to 3.6% roughly, and the daily data suggests they're going to be up in the 3.7% range here over the short term, and that's over 100 basis points higher than where we were at this time last year. And of course, even small changes in rates translate into big impacts when it comes to monthly mortgage payments. Just going from 3% where we were late last year to 4% where we are now adds about $400 to that median priced home's monthly mortgage payment. If they go up to 5%, you're talking about an $800 increase. And that's on the projected median price of about $835,000. So you can think about how that has even bigger effects in markets like Santa Barbara, Montecito, Carpinteria, where median prices are in excess of that statewide average, right? And so I'd be lying to you if I said that there wasn't challenges out there, inventory rates and otherwise. I don't want you to panic. I want you to take a deep breath, right? Because when you look at rates from a historical standpoint, still very low outside of the standards of anything else other than the last 18 to 24 months. I'm still the son of a guy who used to brag about his 12.5% mortgage interest rate. And so I do think that, this is not going to be the factor that totally disrupts the market. I think the benefits of home ownership are certainly alive and well. People who bought homes in 2010, 2012, 2015, and sold them last year made a lot of money. A lot of folks have accumulated equity. We need to get buyers focused on the fact that rates are still low by historic standards, that they're probably going to be more expensive next year. The prices are probably going to keep going up, and that the sooner you get in, the sooner you start accumulating home equity. And I think that, when you just look at the demand numbers themselves, yes, they're down from those 15-year highs that we had in 2020 and 2021. But if you look at the mortgage application index, compared to where we were in 2017, 18, 19, you can still see that we've got a plenty of housing demand, certainly above pre-crisis levels. And so, again, I don't think we have anything to panic about. We just want to have an elbow grease type of approach. The good news is the public health side of this thing seems like it's coming into its lull, where we'll probably have a bit of a reprieve now until about 4th of July when we all go to those barbecues. And I think that will help to fuel additional economic growth, which we already have pegged at about a 4% increase this year. When you look at California, we think that we're actually going to continue to outperform the rest of the United States with a bigger increase in jobs, a better improvement in our overall unemployment rate. We might even see population growth finally start to get back on track this year. And yet we're still expecting sales to go down from about 445,000 units last year to about 420,000 units this year. That's still better than the pre-crisis average of 2015 to 2019, but it is a 5.2% reduction from where we were last year. Prices will continue to go up. We are expecting about an $830,000 median price, which just coincidentally turns out to be a 5.2% increase, just the opposite of what we see on the sales front, but it's going to come at the cost of housing affordability, particularly as rates continue to rise. And we're seeing that we'll probably end the year somewhere around 4.1, 4.2%, which will give us an annual average of about 3.8, and that will have an impact on purchasing power. The good news is the economy's better. Buyers are still out there at, more than pre-crisis levels of demand, and that even with rates going up, they're still favorable from a long-term standpoint. It's a great time to have your home on the market, and from the standpoint of wealth accumulation, it's still a great time to be a buyer. The bad news is, though, is that we won't be able to accommodate all of those buyers. It means prices are going to continue to go up, and with rates going up as well, that's kind of the 1-2 punch when it comes to housing affordability. So we're going to have to work really hard as individual practitioners to get our buyers into the market, to convince those sellers to get their homes on the MLS. But I think that if we can do both of those things successfully, that 2022's got all the makings for having the best year in your business. You just want to keep that kind of an approach. And so with that, I will say thank you so much for your time. I hope that was helpful, and I look forward to joining you all again. See you on the next one.
Thank you, Jordan. Our next raffle donor, Guaranteed Rate. Welcome and thank our next presenter, Randy Glick with Berkshire Hathaway Home Services. Randy has been serving the Santa Barbara real estate community, helping buyers and sellers since 1986. His experience and dedication to his clients have placed him in the top 0.5% of all Santa Barbara realtors for the past 36 years, with over $700 million in home sales. In 2021, Randy and his team sold 40 homes with a sales volume of $77 million. Randy is a UCSB grad, raised his 2 sons in Santa Barbara, and recently celebrated his, wait for it, 30th wedding anniversary with his lovely wife, Jessica. Congratulations, Randy. Randy is known for his long-lasting relationships with his clients and is well respected among the other realtors in his community. Please welcome my buddy, Randy Glick.
Thank you for tuning in today to discuss the 2021 statistics regarding the Santa Barbara South Coast real estate market. It's a privilege to be asked to do this. And as my friend here states, real estate is a stress-free job. I'm 48 and I feel great. I'm speaking today for the most part on the segment of our market below $3 million. To someone not familiar with Santa Barbara real estate, probably sounds crazy. The low end of our market is somehow up to $3 million. My plan today is to cover 3 main components. 1, for 2021, what happened in our market? 2, what themes can we take from the statistics? And 3, what does the future hold for 2022 and beyond? If you don't know what happened to prices in our marketplace in 2021, you probably made so much money in 2020, you took the year off. For starters, I'll share this fact. Of the 933 homes that sold last year, below $3 million, a whopping 55% of them sold for more than the asking price. That doesn't include homes that sold at the asking price, just above asking. I've been told people like to see examples. So here are a few examples of homes that sold for much more than the asking price. The first example is 1817 Clearview Road. This is a west side 2-bedroom, 2-bath, 1,100 square foot main house with a recent additional dwelling unit added that came on the market at $1,395,000. This property closed at $1,561,000, $166,000 over the asking price. Property number 2 is 5 St. Francis Way. This is a recently remodeled 2-bedroom, 2-bath, 1,627 square foot home that came on the market in San Roque for $1,595,000 and sold for $2,050,000, $455,000 over the asking price. The funny thing about a lot of these homes is not only did they get bid up to these surprising prices, but in many instances, the sellers would also get free rent backs and contingency-free offers with no physical inspections, no appraisals, and no financing in play. Property number 3 is 809 Margot Street. It's a single-level 4-bedroom, 2-bath, 1,406 square foot home on the Mesa with a tiny peek of the ocean. This home was listed for $1,695,000 and sold for $2,070,000, $375,000 over the asking price. Last but not least, 3532 Chuparosa Drive, a San Roque home with a legal guest unit. Total square footage was approximately 2,529 square feet. It was listed in November of 2021 for $1,995,000 and sold for $2,760,000, which is $765,000 over the asking price. I was told there were 24 offers made on this home. Enough of this silliness. Let's look at the numbers. New listings for the entire market, again, this is not just below 3 million, but the entire market was down last year 7.4%. Sold properties were up 8.2%. So fewer homes listed, more homes selling. The median price was up 22.6% last year. In 2020, our median ended at $1,550,000. In 2021, it reached $1.9 million. Sales volume was also up. In 2020, in our small little community, we did $3.1 billion of real estate sales. In 2021, that number was $4.4 billion, an increase of 42.6%. As you know, not all transactions go through the MLS. One of our title companies suggests sales volume of close to $5.5 billion in 2021 alone. This is a huge number. I'd like to point out in our last really hot market, which basically ended in 2007, the median price then ended up at $1,225,000, which we all thought was a huge number. Now it's 1.9 million. And the sales volume through the MLS that year was 1.1 billion, which is roughly 25% of what we did this year. Getting more specific about the statistics of homes under 3 million, this next slide shows the comparison of the years 2019, 2020, and 2021 and the different price ranges. What seems most interesting is the sell-through percentages during the 2 COVID years. And in 2019, which was also a very good market, in 2019, the sell-through percentage of homes from 0 to 1 million, 1 million to 2 million, 2 million to 3 million was close to 60 to 65%. So 65% of the homes sold in 2019. In 2020, that number got to 75%. And last year, 95% of the homes that were listed were sold. One other interesting takeaway is just how much our median prices jumped from 2019 to today. As I have mentioned, the median is up 22.6% this year and 39.6% in the last 2 years. This equates to the average homeowner having almost $620,000 of new equity in their home just since the start of 2020. And for homes below $3 million, those homeowners have averaged about $375,000 in new equity. It's time to talk about the future and what we can expect. This picture of Campus Point during Deltopia in 2010 is representative of what it feels like to be a buyer in today's market. There's a fundamental issue we are faced with, and it doesn't appear to be going away anytime soon. The issue is our inventory is shrinking at a fast pace, and our demand is as strong as ever. Last year, in homes listed below $3 million, there were approximately 1,000 listings to sell. That number has steadily declined over the last 20 years. For instance, in 2001, there were over 1,600 homes listed below $3 million. Here is a breakdown of the homes listed by price range in the last 3 years. The biggest difference I want you to look at is in the $0 to $1 million category. In 2021, there were 148 active homes for sale for buyers to look at in that price range. In 2019, that number was 337, a drop of 189 homes, about 60% drop. When we look at the current inventory, we really see what we are up against. As supply shrinks, prices will go up. The Wolf of Wall Street says, "We did have one property in your price range, but I'm afraid we sold it in 1969. Here's what we have for active homes at the time of this presentation. In the $0 to $1 million range, there are currently 3 active homes. In the $1 to $2 million range, there are 14 active homes. In the $2 to $3 million range, there are 17 active homes. So the total of homes listed below $3 million, from Carpinteria to Goleta and everything in between, is currently 34 homes. 13 of these homes are currently pending. So if you have a buyer in your car who wants to spend less than $3 million on a home, you basically have 21 homes to show him. I look back at some of the old MLS information from years past, and in January 2005, there were 312 active homes below $3 million. In 2010, there were 468 homes below $3 million. In 2016, there were 277 homes below $3 million. Today, there are 21 active homes. And as this realtor suggests, and here's your dream home that you have no shot at getting because there are already 70 offers on it. This is the reality of our market moving forward. Unless there are more homes to pick from, buyers who are trying to find a home here will have to fight for what's out there. If nothing else, when you're done listening to this, please call all your sellers and tell them this is a great time to sell their home. In closing, I would like to acknowledge all of the agents listening to this. In a year of great uncertainty between a global pandemic and political chaos, somehow, some way, the home buyers and sellers of Santa Barbara had a remarkable year. With somewhere close to $5 billion in sales volume, it is hard to take for granted the role that all of you have played in handling most of our clients' most important investments. We are good at what we do, and for the most part, get along well. We make what for many of our clients would be a very stressful situation seem amazingly ordinary. Keep up the good work. I look forward to our continued success together. Thank you.
Thanks, Randy. And we'd like to thank our next raffle donor, Draper and Kramer Mortgage Group. Okay, I'd like to introduce our next presenter, Dusty Baker with Sotheby's International Realty. Dusty Baker Group ranks #1 in Montecito within Sotheby's International Realty and among the top 250 real estate professionals out of all brokerages in the United States. With consistent sales in Montecito, Hope Ranch, the Upper East, the Riviera, the Mesa, and more, the Dusty Baker Group is backed by an impeccable track record of success in Santa Barbara's most desirable neighborhoods. The team successfully closed $113 million in real estate in 2021 and $110 million in 2020. Please welcome Dusty Baker.
Hey, everybody. Dusty Baker. Thanks so much for having me. All right, let's get started. 10 minutes is very quick, so I'll speak very quickly. And this is kind of an aerial perspective of what we'll get into. First, thank you, Jennifer Lemert. Thank you very much. All the stats came from Jennifer at Fidelity, and it does include off-market sales, in case you're wondering. Also, kind of fun fact on the side, I thought that the percentage of off-market sales, 3 million and above, would be just sky high this year. We're actually at a lower percentage than years past. So nothing's really changed that much in terms of the percentage of off-market sales. Also, defining the luxury sector, at least for the Association of Realtors and this market update, it's $3 million and up. That's a tough range. That's a big range. So we'll do 3 and up, we'll do 10 and up, we'll do 20 and up. And we'll talk about themes. We won't just talk about stats and make this boring. We'll have some fun, talk about themes, have a few case studies, and then interweave the stats around the themes, kind of giving the backing to what I'm talking about. All right, starting with theme number 1, the records weren't just broken, they were obliterated. There can be a race in the Olympics and the first place wins by 100th of a second. And they're still first place, they set a record, but just by the thinnest of margins. That was not 2021. 2021 absolutely blew 2020 out of the water. And interestingly enough, as you look at these stats, this is number of sales 3 million and above. 2020 blew 2019 out of the water. So we're seeing this incredible growth. This is 3 million and up. This is 10 million and up. Historically, we'll see maybe 10 sales a year over $10 million. 2020 was a big year, 28 sales over 10 million. We had 58 sales over 10 million in 2021. That's absolutely unheard of. And what's even more interesting is 20 million and up. Looking back over the last few decades, there might be 1, maybe 2 sales a year over 20 million. Many years, 0 sales over 20 million. And in 2021, we averaged 1 a month. So just unbelievable. And a lot of these are selling quickly. That's the other thing, is days on market is radically low. We used to see just preposterous days on market for anything 10 and above, certainly 20 and above, and now they're selling pretty quickly. These numbers here, going along the theme of the sprint in the Olympics, they didn't just beat the previous record year by a margin. All of these numbers are about $1 million higher than the other record years. So we're looking at a 20 to 25% increase, even from the last record year. And if you're wondering why Hope Ranch is higher than Montecito, it's because there are condos in Montecito. Excluding condos in Montecito, the median sale price is $4,877,000. So they did beat Hope Ranch just a bit, but these are big, big numbers. Next theme, buyers' wants have turned into needs. If you talk to anybody, high net worth in LA, San Francisco, et cetera, over the last 10, 20 years, and you mention, yeah, I'm Dusty, I live in Santa Barbara. Oftentimes they'd say, oh, I'd love to have a place in Santa Barbara, Montecito and Hope Ranch. My job's here, my community's here. I'd want a place up there. I don't really need a place up there. Well, that's shifted over the last few years. 3 reasons in particular: COVID, kids, and crime. They brought many buyers here. They really checked that mental gauge from want a place in Montecito, Santa Barbara, to need a place because they're healthier. It's better for their kids. They have outdoor space. Their country club closed. Their gym closed. They can have a gym at their house. They can have a pool at their house. It actually is a legitimate need. They can convince their spouse, we need that big estate in Montecito. It's better for the family. And for the first time, it actually really was. The last piece, the crime piece, is kind of interesting. Obviously, we've been seeing on the news a lot of the crime in the major cities. If you have some time today, call your friends in Beverly Hills. Crime is very interesting in Beverly Hills right now. isn't quite hitting the news. And if you have time, call your friends and ask, and they'll have a lot of stories. It's really devastating, and we're seeing a lot of buyer response from that already. I think that will just increase. Obviously, it's no surprise that Burnham Wood and Esbrook are, no inventory, because people are really valuing. There's a guy at the gate, protecting the houses. And then the remote and hybrid work options, they're keeping the people here. So it went from want to need. What's going to keep people here? Listen, is there a discussion and a thought process of a lot of people? There will be a mass exodus away from sleepy areas like Santa Barbara back to buzzing big cities once COVID is over. Sure, everyone is saying maybe that's going to happen to Santa Ynez or Carmel by the Sea or some of these, sleepier areas. We're just not seeing that yet. And we're seeing a lot of people really enjoying the kind of hybrid work option. And that's what nationally we're seeing statistically, is that people are moving further and further out from their point of business. If they only need to be there 1 or 2 days a week, listen, you can live in Montecito or Hope Ranch, go to San Francisco 1 day a week, live here, go to LA 2 days a week. So I don't think it's going to be quite the mass exodus people are anticipating because of these remote hybrid work options. And also, let's be frank, a lot of our high net worth here don't have traditional jobs. So it's not a 9 to 5 that they really need to worry about. Theme number 3, community through proximity. Listen, to use an example of Montecito, everything is selling in Montecito. Even up in the hills, down in the flats, on the beach, everything is selling. However, if we're thinking about the areas that have seemingly endless buyer demand, it's Middle Road, Hedgerow, Lower Golden Quadrangle. It's these proximate areas where people can walk to the beach, both the villages. It's a bit more flat, usable land. It's what a lot of our current buyers want. We're getting a lot of young families here, which I think is great. I think it's really fun. And when they want space for their kids, when they want to come and feel like they have a community, see other people pushing strollers, they can feel isolated way up in the hills. And that's the feedback that I'm getting from a lot of my clients, and I'm hearing that from other agents' clients as well. A few other reasons and factors that are pushing people towards areas like Hedgerow and Middle Road, for example, but I think this is Hope Ranch works with all of these as well, is that there is still a legitimate fear of fires, not necessarily for the home burning down, even though that's there, but insurance is through the roof. It's less convenient. You feel a bit more isolated. The lower portions, like those 2 neighborhoods, have more usable land for kids. They're typically a bit more understated in their aesthetic. I get a lot of clients that, they're extraordinarily wealthy, but they don't necessarily want to show that wealth in their home, and they like the understated, comfortable, nice homes. And just in general, there's less aversion to noise. It's so funny. Do you remember when San Leandro was too loud? When everyone said, "Oh, I can't buy in San Leandro. There's, the ambient noise from the freeway." And now you'd have to give your firstborn to buy a home on San Leandro. It's so difficult to secure a home in the Hedgerow area. It's so popular. So people are caring a lot less about the silly details of ambient noise in the background. Here's a case study. I just sold 445 Hot Springs Road, multiple offer situation, countless showings, lots of young family interest, because we can walk to Upper Lower Village, single level home, works well for families. Obviously, I don't promote that with fair housing, but it just does. Flat acre lot. And even after we put it under contract, I was getting 1 or 2 phone calls a day for showings. I'm telling you, endless demand for properties like this in areas like this. The 4th and final theme is just economics 101, supply and demand. If we're banking on valuing a property solely based on other comparable sales, on price per square foot, on what it should be worth, we're just missing the point here in what buyers are thinking, because they're not just valuing the home for the brick and mortar and for what it should be worth, or even what the remodel will cost to bring it to this level, which then is similar to the neighbor. It's valuing their own time and their own enjoyment, because inventory is so low that when will be the next home that comes on the market? How many trips do they have to take to Santa Barbara before they secure a home like this? If they're worth $1 billion, imagine what their day is worth. Imagine what a flight is worth to them in terms of opportunity costs. So we have to understand that we're seeing some crazy prices, but it's not that crazy when you factor in the fact that low inventory means that buyers are having to factor in their own time and their own enjoyment into the purchase price. And quite frankly, we're seeing that on the low end as well. We're seeing even the $1 million to $2 million range, which I'm sure Randy chatted about, getting these multiple offers, no contingencies, way over asking, because a lot of these poor folks, they need a home. They have multiple kids' needs for multiple bedrooms, and they've lost out on 8 or 9 homes. Imagine how frustrating that is. So that extra $100,000 where you think it sold $100,000 more than it should have, well, they paid $100,000 for some quality of life to actually be in a home and start this next chapter of their life. Here's a case study on that. Listen, I don't think 1655 Fernald Point Lane sold for a price, well above what it should have. Frankly, if you wanted to buy in the sand right now, good luck. And maybe this was the deal of the century at 45 million. However, imagine the negotiations going on between the buyer and the seller. Imagine how much more valuable the time is for the buyer having to go back and forth. And if they really want this property that's on a flat acre, desirable beachfront, enormous main home, guest house, 3-car garage, studio apartment, gated entry. If you want that, when will you find the next one? I haven't seen another one like this. And you'll probably have to pay a lot more anyway. So you look at something like $45 million for this, and you might think it's high. A, I don't think it is, but B, you have to factor in so many other variables beside just, well, when was the last home that sold for $45 million? So ending here, as we look towards 2022, obviously we don't have data to support anything yet, but based on what I'm seeing in my business, what I'm seeing in other folks in different companies in my kind of sphere, it's not slowing down. I think this will be even more robust than last year. Obviously, inventory is very, very low. It's going to be very difficult to put deals together. Buyers, good luck. Sellers are in a really good position, but this will stay really robust. We're going to see a lot of sales. We're going to see a lot of really strategically written offers with no contingency, short closes. We're going to see homes that if they or buyers that have to get financed, they're going to do really short periods. I feel bad for lenders these days, but this should be a really robust year. And it has not started to slow down, especially in the luxury sector. We are not seeing people slowing down. This flood of buyer demand is still coming. I'm seeing wave after wave after wave, and I think this will be a really robust year. So thank you so much for having me. Really appreciate it.
Thanks, Dusty. And we'd like to thank our next raffle donor, Melody Maddox with First American Home Warranty. Okay, I'd like to welcome our last presenter, Caitlin McCahill Hensel with Hayes Commercial Group. Caitlin has been with the Hayes Commercial Group since 2008, specializing in commercial sales and leasing in Goleta, Santa Barbara, Montecito, and Carpinteria. Adept in the representation of both landlords and tenants, Caitlin is one of the region's most active agents, averaging more than 60 transactions annually over the last 5 years. In total, Caitlin has represented clients in more than 300 commercial transactions, totaling over 1 million square feet and $186 million in dollar volume. She was recognized in recent years by the Pacific Coast Business Times as a 40 under 40 recipient, the top 50 women in business recipient, and a CoStar Power Broker. Would you please welcome Caitlin Hensel?
Thank you for that wonderful introduction, and thanks for having me. Hi, everyone. I'm Caitlin Hensel. Santa Barbara is a small town, so I'm sure you all recognize one of the faces up on the screen. These are my colleagues at Hayes Commercial Group. We are 11 of about 50 brokers in the county. We specialize in investment sales, acquisitions, landlord and tenant representation, and we cover all commercial sectors, including office, retail, industrial, hospitality, multifamily, basically everything except for houses. So my job here today is to give you a high-level overview of trends in Santa Barbara commercial real estate so that you can share some locals-only behind-the-scenes knowledge with your clients. A quick look back to 2020 to give it some context. We were coming off our biggest year ever at the time. And then, of course, COVID threw us into a recession. For about 6 months, we were at a complete standstill. But then towards the end of the year, sales picked up significantly. So much so that some of our largest transactions ever happened in the middle of a pandemic. You'll recognize these campuses, but Appfolio, Procore, Amazon, LogMeIn, All of these properties sold within between 20 and 60 million, which are huge numbers for our market. So despite what the national narrative is about commercial real estate, locally we're actually pretty booming. As evidenced by our 2021 results being a record year, the sales volume of 770 million in 117 sales are just records off the chart. We had to actually extend the y-axis on this graph in order to fit all this activity. A few takeaways: that the majority of the activity was in Santa Barbara as opposed to Goleta or Carpinteria. 49 of the 117 were off-market deals, and almost half of them were owner users. So that means that a business purchases a property for their own use to occupy, as opposed to an investor. Looking at leasing, so we're definitely better than last year, which is good, and we're gaining momentum, but we're not quite at pre-pandemic levels. So it's a recovery year for leasing. We did 125 million in leasing volume in 270 leases. I'm going to go sector by sector, starting with retail sales. And obviously, we all know this is our most challenging sector. All you have to do is walk down State Street to see the vacancy. So that's still high for our market, but I wanted to focus on the positives and share some encouraging behind the scenes activity. So first off, Planet Fitness leased 21,000 square feet out in Goleta at the Albertson Center. Mattress Mike and Miss Daisy's Consignment are both two new tenants in the Sears building, taking up 17,000 square feet. And the Athleta building, they finally came into town, our first national retailer in a lot of years. And if you are hoping for more alcohol establishments, you are in luck. Augie's Tequila Bar and Restaurant will open on the 700 block, hopefully later this year. Belching Dragon Tavern, which is a concept made up by a bunch of local investors as well as the building owner, will take over where Starbucks used to be on De La Guerra. And Validation Ale is going through their permits to open in the Funk Zone. So including these three, there are a rumored 32 new food and beverage uses that are supposed to open this year. Looking at retail sales, the theme here is repositioning. So basically taking a traditional retail building and making it into something else entirely. So just a few months ago, the Macy's at La Cumbra sold along with the neighboring parking lots for 63 million. And once the Macy's lease runs out, this will become housing. The Nordstrom downtown sold to a development group for 13 million, and they plan to make it into office. Sur La Table building sold to a local investor and developer, and he is not sure what he's going to do with it quite yet, but it will most likely become either office or housing. And then the Enterprise Fish Company building, the restaurant, you've probably seen this under construction, but this is going from restaurant to office. We've also had a handful of very high profile corner food and beverage properties trade in recent months, including the Public Market, which sold for right around 10 million. And rumor has it a liquor license and potentially an arcade are in the works. The Santa Barbara Winery and La Fond buildings in the Funk Zone on those three corners also traded for 10 million. We'll see some turnover there. And the Oriana property down in the Funk Zone as well was purchased by the owners of Pally Wines. I put some price per square foot there just to give you the difference between Santa Barbara, Goleta, and Carp. But in general, with retail, leasing is challenged and sales are really active. Looking at office leasing, which has been an interesting sector to watch. The active parts of this sector are the high-end and professional services type spaces. So Keller Williams moved over to Chapala, West Coast Financial backfilled them on Anacapa Street. So these are really active, and that kind of means, real estate, law, finance, any high-end use. And then specialty offices have also been really busy. So this is usually lab space or, medical research and development for aerospace and defense companies, that sort of thing. Co-working and small single offices have also been really active. And that's just because people are trying to get out of their houses after 2 years in a pandemic. And then the renewals have been really busy. So a lot of these downtown tech tenants have actually renewed their leases long term. And so that's a really good sign for our local economy. The quiet sectors of office leasing have been the larger floor plates, so 5,000 square feet plus, and then the Class B and C offices, meaning dated, needs some new amenities, needs floor plan changes or new finishes, and non-ADA accessible properties. The interesting highlight from office leasing is that despite vacancy being higher than normal, the achieved rates are actually a little bit higher than they were last year. Moving over to office sales, looking at owner users. So again, meaning a business purchases a building for their own use. Westmont College purchased a property on Anapamu. Ocean Hills Church purchased a property on Anacapa Street. And Flowers and Associates purchased a building on Canon Perdido Street. These are just a few of many. And then for investment sales, so as opposed to owner users, this is someone looking for a return on their investment. We've had a lot of off-market deals, and I'm just highlighting a few of many again, but the Appeal Sciences building in Goleta traded for $36 million, and that was a triple net single tenant leased investment. And then hopefully you recognize the building with the bougainvillea down there, the Libero office building, also sold for about $16 million. And this continues to house about 40 local businesses. So while leased investments are typically more desirable with investors, there's also a lot of value add buyers out there, meaning that, especially in Goleta, that they're buying these vacant or partially vacant properties, re-tenanting them and renovating them and making a greater return. Moving over to the industrial sector, which is kind of our hottest sector. Within industrial leasing, there's kind of two categories. There's the warehousing and shipping and receiving, which are kind of the rougher warehouses, and then the manufacturing and production, which is more specialty. So within the warehousing sector, there have been a lot of food and beverage uses out there. Especially in the last 6 months, we've seen, Cape Farms, Lemonkind, Giordano's, Kopu Water, all these companies leasing 10,000 square foot plus spaces. And then a lot of hardware resale businesses as well. For manufacturing and production, where they're actually making something in the space, aerospace and defense companies, again, have been really active. Deployable space systems, for example, leased a huge space out in Goleta, and they're making specialty pieces for satellites. And then, of course, construction and the trades are very busy and always looking for space. And then alcohol production is always a hot sector in our market. Cutler's actually just leased a distillery where Telegraph was on Salsipuedes. So here's a phenomenon that's blowing us all away in the real estate world. What do all of these small industrial sales have in common that traded within the last 12 months? They all went to high-end personal storage buyers. So these are high net worth individuals that are buying these properties for storing their vintage cars, their boats, playing poker with their friends. And the interesting thing about these properties is that they're such in high demand that they're actually going way over asking, multiple offers. Some of them are contingency free. It's basically the residential market in small industrial space. For larger industrial sales, they've been a little slower to sell on the market, but still really desirable property. And that's just because it's more of a unique buyer in these higher numbers. But the platform on Haley, you might recognize that mural there, sold as a multi-tenant leased investment for about $14 million. The food bank bought 2 properties out in Goleta for their own use, and an investor bought this industrial complex on Upper State Street in an exchange. So hospitality, this is a sector that we've seen more activity here than anyone's ever seen in their entire careers. The Hotel Californian, you've probably read about, traded for $130 million, sold to Bill Foley. The Hotel Santa Barbara sold to Diane Hendricks, who I've heard is the world's richest woman. The Hotel Indigo just sold. The Goodland in Goleta just sold, and the extended stay in Pacifica Suites also traded. And there's more in escrow, so it's going to keep happening. The Franciscan Inn and Quality Inn as well. And if you're thinking that these buyers are getting COVID discounts, it's not necessarily the case. The downtown properties, California and Santa Barbara and Indigo, all traded for over $1,000 per square foot. Looking forward into 2022, obviously COVID has thrown a few wrenches in our predictions, but I think these are a few predictions we have that we think are pretty safe to say, that there will continue to be high demand for both owner users and investors in our market. Due to the low inventory we are going to have for the next few months, due to our very active 2021, and potential increasing in interest rates, that could limit deal flow. And also due to the low inventory, I think off-market sales will continue. And then for State Street, I think it's looking really positive long-term. With the walkable promenade, which we all hope will stay in some capacity, and the developments in the repositioning, the trading of the hotels, all the new restaurants opening downtown, I think we just need to give it a little more time. And then developments, there's a lot in progress right now. I didn't have time to cover that today, but keep a lookout in the Funk Zone and Lower State Street, because I think we're going to see a lot of change in the next 5 years. Overall, we expect 2020 to be another really strong year in commercial real estate. Hope you've enjoyed your crash course in commercial real estate. Please stay in touch, and thanks for having me.
Thanks a lot, Caitlin. And now it's time to raffle off our grand prize for the day. I'd like to welcome our raffle sponsor, Sarah Sinclair with the Santa Barbara Independent.
Thank you, Paul. I'm Sarah Sinclair. I am the advertising director at the Santa Barbara Independent. We are very pleased to sponsor today's event and the part of the event that you've all been waiting for, the raffle prize. Before we get to that, though, let me just say that we are so pleased to sponsor this event, and you've seen us do it so many years in a row that I'm sure you already know that the Independent is here for you with advertising solutions to help you and your business grow and expand in the community. We reach over 60,000 people every week with our print edition, and we have great advertising rates to help you promote. What you may not know is that we also have digital programmatic solutions that we are happy to talk to you about to help you expand your reach. We also have a free weekly e-newsletter all about real estate that we'd love to tell you more about. And we are here to help you grow your business. We'd love to tell you more about our solutions. You know where to find us every week. To contact us, contact me, sarah@independent.com. I look forward to seeing you all out on Caravan, at your office meetings, and working with you into the future. But now, what you've all been waiting for, I will turn it over to Casey, who is going to draw one grand prize winner for 4 $100 restaurant gift certificates. We chose this prize because we are so happy to continue to support local in the name of the Santa Barbara Independent and Santa Barbara Association of Realtors.
And congratulations to all our raffle winners, and a huge thank you to our presenters, sponsors, raffle donors, and the 2021-2022 Statistical Review Committee. And as a reminder, this presentation will be available tomorrow on the SBAOR website. Thanks for joining us. Stay safe and have a great day. See you next year.